Over the past few weeks, several major AI-related deals have made news headlines. NVIDIA plans to invest up to $100 billion into OpenAI to help build their data centers. Then, OpenAI signs a $300 billion deal with Oracle to purchase their computing power over the next 5 years. And in turn, Oracle plans to buy $40 billion worth of NVIDIA chips to support OpenAI's infrastructure's build-out. Each time one of these partnerships is announced, the market reacts positively, stock prices surge, investor optimism spikes, and the AI narrative grows even stronger. But if you trace the flow of capital behind these deals, a pattern starts to emerge. Many of them are circular in nature, where companies often act as investors, suppliers, and even customers to one another. And now, a growing number of analysts are starting to sound the alarm, warning that these circular deals may be artificially inflating demand and masking the true profitability in the AI industry. In this video, we will unpack how these circular deals actually work, whether they represent a smart form of strategic collaboration, or are they actually fueling an unsustainable feedback loop that could eventually cause the AI bubble to burst. To understand the extent of these deals, all you have to do is look at this chart by Bloomberg, which maps out the web of partnerships and investments between the biggest names in tech. For example, looking at OpenAI, its list of its partnerships is staggering. They have a multi-billion-dollar cloud and integration deal with Microsoft, which not only hosts OpenAI's models on Azure, but also embeds them directly into Office, Windows, and GitHub. Then there are deals with Ambience Healthcare, Huawei AI, and Anysphere, which are building on OpenAI's technology stack. And of course, the most recent deal between OpenAI and AMD. Then there's NVIDIA. It seems like NVIDIA has a deal with almost everyone: Microsoft, OpenAI, Oracle, Intel, and CoreWeave, to name a few. Whether it's supplying chips, taking equity stakes, or co-developing infrastructure, NVIDIA sits right at the center of the AI economy, with money flowing to and from nearly every major player in the industry. And even then, this isn't the full picture. Even the US government is part of this web, holding a 10% stake in Intel through the CHIPS Act funding, and taking a 15% export levy from NVIDIA and AMD whenever they sell chips to China. Then there's a $10 billion deal between Meta and Google, and another $20 billion partnership between Oracle and Meta, both of which were announced this year. And just as when I was producing this video, Broadcom announced yet another deal with OpenAI to develop custom AI chips alongside NVIDIA and AMD. Basically, deals everywhere, and there aren't just simple partnerships. Many of them are circular in nature, where Company A buys chips from Company B invests in Company C, and Company C ends up purchasing services from Company A. Together, these relationships represent trillions of dollars in capital commitments. Quick pause. If you're looking for the best brokers to kickstart your investing journey, check out Interactive Brokers. You will enjoy one of the lowest fees in the industry, at just 35 cents per trade on the US stock market. It also offers Ireland domicile ETFs, perfect for saving on dividend withholding taxes. Plus, it also comes with free company research tools, so you can make smarter investing decisions. Feel free to use my Interactive Brokers link to open an account and start investing today. Alright, let's get back to the video. At first glance, these partnerships seem like the natural next steps in the AI revolution, where big and powerful companies are teaming up to meet extraordinary demands. But behind the hype, several investors and analysts are starting to worry that the AI economy might be propped up by circular money flows, thin profit margins, and sky-high expectations that may not actually hold. For example, Morningstar analysts warn that if we get to a point a year from now where the AI bubble pops, these deals might be one of the early breadcrumbs. Now, their concern isn't that the deals are illegal or deceptive, but rather, they may be artificially inflating valuations across the industry. Take Oracle for instance. Despite striking multi-billion-dollar partnerships with OpenAI and NVIDIA, the company reported only $900 million in incremental AI-related sales, and a gross profit of just 14 cents for every dollar of revenue. In other words, while the top line may look spectacular, the margins are razor thin. Yet, executives insist that these deals are necessary to meet unprecedented demand. For example, AMD CEO Lisa Su calls it a virtuous positive cycle, while OpenAI President Greg Brockman argues that it takes an industry-wide effort to meet the immense computing demands. Meanwhile, NVIDIA's Jensen Huang is also bullish, saying that there's no end in sight for AI demand and calling this the beginning of a new industrial revolution where two exponentials are happening at the same time. In other words, demand for AI is growing exponentially, while AI itself consumes exponentially more computing power. But it's precisely this optimism that's raised concerns. The deals may not be intentionally circular, but when capital keeps recycling through the same small set of companies, it can froth up the market and distort the perceptions of real demand. For instance, when Nvidia invests in or supports its biggest customers, it may give them the push they need to keep buying. Then there's OpenAI, now reportedly valued at nearly $500 billion, despite burning cash and not generating profit, at least until 2029. And yet, the company has become so integral to the AI narrative that investors treat it like a proxy for the entire sector's future. Which then raises the question, are these circular deals simply inflating valuations without creating proportional economic value? On one hand, supporters argue that this is just how innovation works, using debt, equity, and collaboration to accelerate breakthroughs. And unlike the dot-com era, AI products are already being adopted by businesses and consumers in everyday life. But on the other hand, the scale of AI spending is far larger than what we saw during the early 2000s. And if returns don't eventually catch up, the AI bubble could be even bigger than the dot-com bubble, with far higher stakes if it bursts. As one Bernstein analyst puts it, Sam Altman has the power to crash the global economy for a decade, or take us all to the promised land. If OpenAI manages to turn profitable, all of these investments might be justified. But because of how interconnected everything is, any slowdown could cascade far beyond tech, hitting suppliers, data center operators, and even financial and real estate markets tied to AI infrastructure. Now, to be fair, not everyone believes that these circular deals are a ticking time bomb yet. Many industry leaders and analysts argue that what we are seeing isn't actually a bubble, but a natural stage in the rapid scaling of a transformative technology. If we look at it from this perspective, then these arrangements aren't deceptive. Instead, they are strategic alliances designed to ensure that the AI ecosystem can grow fast enough to meet real demand. Take, for example, the sheer scale required to train models like GPT-5, Gemini Ultra, or Sora 2. Each of them require massive computing power, specialized chips, and global data center infrastructure. Building that kind of capacity requires close coordination between hardware manufacturers, cloud providers, and AI developers. And this kind of cooperation, even when it looks circular on paper, is actually necessary to prevent supply bottlenecks. When Nvidia invests in data center partners or OpenAI collaborates with multiple chip makers, they are not inflating demand. Instead, they are front-loading investment to build capacity before it is needed. Analysts at UBS have also downplayed the risk. In their October 2025 CIO report, UBS notes that the scale of the deals is not overwhelming, citing that the OpenAI Nvidia arrangement alone is estimated to represent up to 13% of Nvidia's projected 2026 revenues. In other words, even among headline AI deals, the magnitude is still relatively small compared to the overall market. Besides that, unlike the dot-com era, AI is already powering real revenue-generating products used by millions every day. ChatGPT, for instance, still commands roughly 82% of the global chatbot market, with about 75% of its revenue coming from paying customers. And while it is true that profits across the ecosystem remain thin, early-stage industries often require years of heavy spending before economies of scale kick in. But perhaps what's comforting is that the financial health of many leading AI firms remains relatively solid. Most of the major players, from Nvidia and Microsoft to AMD and Amazon, are still generating healthy cash flow while carrying manageable levels of debt. Not just that, their valuations, while high, are not completely detached from fundamentals. Unlike the dot-com era, where companies with no revenue traded at 60 times forward PE, today's AI giants are closer to 35 times, with stronger balance sheets and more predictable earnings streams. This suggests that the market is not pricing in unrealistic growth expectations, and that companies are better positioned to weather potential slowdowns. So, should we be concerned about these circular deals? The answer, as always, lies somewhere in between. On one hand, these partnerships have clearly accelerated innovation. Without them, it's hard to imagine AI models like ChatGPT, Gemini, or Sora scaling as quickly as they did. The collaboration between hardware, software, and cloud players have created an infrastructure boom that's driving real technological progress, and at least for now, record profits for the biggest players. But on the other hand, it's getting hard to tell how much of this growth is organic and how much is financial feedback. While the situation feels a little similar to the early 1990s, where optimism, exponential projections, and record capital flows, the difference this time is that AI isn't selling promises, it is selling products that millions actually use. However, with that being said, this doesn't guarantee immunity from market cycles. As history shows, hype often outpaces adoption. And when that happens, corrections often happen. Anyway, that's all for this video. Hope you found this useful. Like, share and subscribe as I'll be posting new videos every week.